Hi there, this is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the Portfolio Manager for Fundstrat's U.S. Large Cap Granny Shots ETF. I'd like to zoom out because the market's been through a rough, turbulent period recently. And as you can see, the S&P at 5770 is roughly at the same level it was 8 months ago. In fact, the market actually has been arguably trading in a pretty wide range over the past 8 months. Now, that might raise some questions for you, such as, well, with this recent correction, does that mean stocks can stage a strong rebound, or is there even fuel left for stocks to have upside? So let me just sort of point a few things out for you. If you look at money market cash balances at the end of July of last year was 6.1 trillion, and they're currently 7 trillion. So even though the S&P's been roughly at the same level, money market cash has risen by roughly $850 billion. That's a lot of dry powder on the sidelines, ready to buy stocks. If you look at margin debt, even though the S&P is at roughly the same level, margin debt has been declining recently, and we don't have the number for the end of March just yet. It's published monthly, but my guess is that it's come down a lot. So I don't think margin debt has risen significantly. Again, that means there's some dry powder there. And if you look at fundamental long short positioning by hedge funds, this is data provided by a prime broker. You can see that the net long positioning is the lowest. It's much lower than it was a year ago. And really, it's the lowest since before 2020. All of that to me looks like it's fuel for upside, especially for a market that's been stuck in a range. And I think it is fuel for a face ripper rally. Now, the pretext to this, and it's been something I mentioned last week, is that the stock market had a waterfall decline, the fifth fastest 10% decline ever since 1950 at least, and that those other six precedent declines of 10% in a similar time period were actually shocks to the market. They weren't the start of a major downturn. So when you think about stocks from their 52-week highs falling this fast, this qualifies as a shock. Now, the drivers for this shock are, of course, the tariff war, the risk that Doge will create a recession, and that's evident in the anxiety of consumers. This notion that there's no Trump put and no Fed put. So these are the reasons why markets lost faith over the past month or so. Now, last week we got a reminder that there was actually a Fed put with the FOMC rate decision. And as with regard to the tariff war, as you can tell recently, the rhetoric has been dialed back, and it looks like there will be some deals coming into place, but it won't be as drastic as many expected. In fact, it looks like Trump wants to make a deal. As for a Doge recession, um, that remains to be seen, but given how we've dialed back rhetoric around a tariff war, I wouldn't be surprised if there's going to be dialed back rhetoric around the severity of cuts around Doge. And then lastly, I think, and it's something we addressed last week, that there is a Trump put, and it's been evident by what's happening with Tesla stock. In fact, in our view, Tesla is exhibit A for a face ripper. If Tesla can stage a V-shaped recovery, I think that that's a template for what the S&P can do. Now, for a little context, Tesla has fallen 50% from 488 in December to a low of around 220. And the reason for that is that Elon Musk has become quite controversial because of his role at Doge, so much so that some analysts are calling for Elon Musk to take a step back from Doge. Now, that's not something that the White House wants, because if Elon Musk leaves Doge and goes back to Tesla, that might be good for Tesla, but that would stall, I think, a lot of the efforts for Doge and the government finding cost savings. And so as a response, the White House obviously wants Elon Musk to stay, and part of that has to come with actually making sure Tesla stock actually stops falling. So that is the Trump put at play. In fact, I think that's why we're starting to see what looks like to be a V-shaped bounce in Tesla. Our technician, Mark Newton at Fundstrat, believes 330 is the key level to watch. That would confirm a V-shaped recovery is underway, and that would allow or set the stage for Tesla to make all-time highs again. So from a Tesla perspective, which is owned by the Granny Shots ETF, it makes sense to actually stand firm here, expecting Tesla to bounce strongly. As for Granny Shots stock contribution over the past week, as you can see here, roughly 2/3 of the Granny Shots outperformed the S&P over the past week. The top 5 contributors to performance were GE Vernova, Cadence Design Systems, Palantir, Advanced Micro Devices, and Netflix. The bottom 5 contributors to performance were Garmin, Meta, NVIDIA, Progressive Corp, and Accenture. Now, Accenture, of course, got hit hard because of its exposure to consulting as a government contractor. It is something that we have been mindful of and talked about at Fundstrat in our 2025 outlook. In terms of factor performance by style or theme, energy and cybersecurity was the best relative performing theme. These are the stocks leading here. As you can see, it's GE, Vernova, Palantir, and CrowdStrike. And the second is the style tilt, which is quality growth. It makes sense here to be in quality growth, especially if there is a V-shaped bounce. And as you can see, the leaders here. And the third is the PMI recovery. In fact, if you didn't have the negative contribution from Accenture, this would be doing a lot better. But you can see the leaders here are stocks leveraged to a PMI recovery like Goldman Sachs, JP Morgan, S&P Global, Bank of New York, PayPal, etc. Now, if you're wondering what a granny shot is, it's referring to an unconventional way to throw a free throw popularized by Rick Barry, NBA Hall of Famer, who made 90% of his shots. The way we implemented granny shots portfolio is we look at durable long-term structural themes like millennials, global labor suppliers, the rise of AI and automation, energy and cybersecurity, as well as easing financial conditions. And we have tactical portfolios like style tilt, seasonality, and of course, a PMI recovery. In order to be a granny shot, though, not only should a stock appear in one of these key themes, it has to appear in more than one theme. And so the stocks that appear in most frequently are really the most granny of the granny shots. There is more information available on our fact sheet, which can be found at grannyshots.com. And this is the investment team. Thanks for listening, and I'll speak to you soon.
Don't